All right, let's get settled, everyone. Welcome back to class. Today, we're jumping straight into Chapter 3, which is entirely focused on the accounting for payables and receivables. I'm genuinely thrilled to walk you through this material because, frankly, we're dealing with the absolute lifeblood of any enterprise, the cash we're owed and the cash we owe to others. So, let's dive right in and build a rock-solid understanding of these critical current assets and liabilities.
Here's our roadmap for today's session. We've got 5 core areas to cover. We'll start with accounts receivable and payable, then move into tax accounting. After that, we'll tackle accounting for borrowings, followed by deposits and pledges, and we'll wrap up the day with the issuance of ordinary bonds.
So, let's kick things off with our first major topic, accounts receivable and payable.
Now, what's really fascinating about account 131, that's our accounts receivable account, is its dual nature. Unlike some accounts that strictly sit on one side of the balance sheet, account 131 is perfectly capable of carrying both a debit and a credit balance. Because of this, it is absolutely crucial that we track it by individual customer. A debit balance simply means the customer owes us money. They haven't paid for the goods yet. But a credit balance? That means the customer actually gave us an advance payment and now the enterprise owes them a delivery.
Let's test your intuition here with a quick scenario. Imagine we sell some goods to Big Mart for 200 million VND, plus a 10% VAT, making the total collected 220 million. Why must we go to the trouble of recording that 20 million VAT separately in account 3331 instead of just logging a clean 220 million right into our revenue account? Think about it for a second. The answer is that output VAT is simply not our revenue. In this transaction, the enterprise is literally just acting as a tax collector on behalf of the state. Including it in your revenue would completely misstate your actual operating results.
Moving on, we really need to make a strict academic distinction between 2 types of discounts that honestly trap so many students every single semester: trade discounts and settlement discounts. A trade discount happens right at the time of invoicing, usually because the customer bought in bulk. This directly reduces your revenue in account 511. However, a settlement discount happens entirely after invoicing, specifically because the customer paid early. So the crucial takeaway here is that a settlement discount does not reduce revenue at all. It's logged strictly as a financial expense for the seller over in account 635.
Of course, out in the real world, not everyone pays their debts. Under the prudence principle in accounting, we have to recognize losses immediately, when we have solid evidence, without waiting for the actual cash to officially disappear. Circular 48 gives us a very strict aging schedule for setting up allowances in account 2293. It's essentially a sliding scale of risk. If a debt is overdue by 6 to 12 months, we provision 30%. From 1 to 2 years, it bumps up to 50%. 2 to 3 years is 70%, and anything dragging on over 3 years requires a full 100% provision.
Let's see how this actually builds into a real-world journal entry. Imagine Company X owes us 100 million, and they're 14 months overdue. That puts them squarely in the 50% bracket, so we need a 50 million provision. Let's say we already provisioned 30 million last year. Step 1 is to top that up by 20 million, so we debit 642 and credit 2293. But what happens when Company X officially goes bankrupt the following year? Step 2. Say we manage to recover 20 million in cash, so we debit 11.1. We then have to write off the remaining 80 million. We utilize our full 50 million provision by debiting 2293, and the leftover 30 million loss hits our administrative expenses, so we debit 642.
All right, let's flip the script completely and look at the supplier side with account 331, our accounts payable. This beautifully mirrors the exact mechanics of the receivables account we just discussed, just from the buyer's perspective. The credit side represents our obligations, like when we buy on credit or receive advances. Meanwhile, the debit side logs the actual payments we make to our suppliers or any purchase returns we initiate.
Moving right along, let's tackle our second major topic for the day, tax accounting.
Now, we use the deduction method for value-added tax. At the end of every single month, we have to offset our input VAT against our output VAT. Consider Tan Phot Company. They tallied up 130 million in input VAT from all their purchases, but they only had 120 million in output VAT from their sales. Because the input is greater than the output, we offset the maximum overlapping amount, which is 120 million. And don't worry, that remaining 10 million isn't lost. It's perfectly carried forward to the next period over in account 1332.
Time for another core concept check, and this one is vital for corporate income tax. Why on earth wouldn't your accounting profit perfectly match your taxable income? The culprit here is non-deductible expenses. Just because you recorded an expense in your internal accounting books, like taking a client out for an excessively lavish dinner, doesn't automatically mean the tax authorities are going to let you deduct it from your taxable income.
Let's crunch the numbers for a final corporate income tax calculation using Pooh Thin Company. They're sitting on an accounting profit of $5 billion, but because they have $200 million in non-deductible expenses, their actual taxable income jumps to $5.2 billion. At a standard 20% tax rate, their total tax liability is $1.04 billion. Now, over the 4 quarters, they already made provisional payments totaling $900 million, so at year-end, they only owe an additional $140 million. We record this simply as debit 8211 and credit 3334.
Okay, everyone, still with me? Let's transition into our third topic, accounting for borrowings. There are 4 golden rules you absolutely have to remember for account 341. First, all cash borrowings go here, and we do not separate short-term from long-term by account code. We only separate them on the final financial statements. Second, and please don't fall into this trap, bonds must never be recorded here. They go strictly to account 343. Third, how we treat interest depends entirely on the payment method you've agreed to. And fourth, if your interest qualifies for capitalization under VAS 16, it bypasses the expense accounts entirely and goes straight to account 241 or 627.
So let's detail those interest methods. You can pay in arrears at the very end of the loan, periodically throughout the life of the loan, or in advance. I want you to pay close attention to the recent Circular 99 update regarding prepaid interest. We no longer park prepaid interest in account 242. Instead, it's recorded directly as a reduction in account 341 and then amortized from there.
Let's apply the simplest method, periodic interest, to Dai Viet Company. They take out a $2 billion VND loan at 9% per year. Step 1. They receive the cash on January 1st. Step 2. Every single month, they pay $15 million in interest, logging it directly as a financial expense. Debit $635, credit $112. Finally, in Step 3, at maturity on December 31st, they repay the original $2 billion principal alongside that final month's $15 million interest payment. Clean, simple, and straightforward.
Moving right along into our fourth area, deposits, pledges, collateral, and mortgages. Generally, we use account 244 for cash we deposit as security, but let's look at a bit of a twist with Tung Lai Company. They put down a $500 million deposit, but unfortunately breached their schedule, which incurred a $50 million penalty. Now, why do we record this penalty in account 811 for other expenses instead of our standard financial expense account 635? It's simply because a contract breach isn't a normal cost of raising capital or financing your operations. It's considered a sporadic, non-operating penalty.
And finally, we arrive at our last and arguably most advanced topic for today, the issuance of ordinary bonds. You've got to understand the structural anatomy of account 3431. The credit side is where we log the bond's face value the moment it's issued, as well as any premium if we manage to sell it above par. Conversely, the debit side is where we track the bond repayments at maturity or any discount that arises if we are forced to sell the bonds below par.
Let's bring this theory into the real world. Haiphong Co. decides to issue 10,000 bonds at a 1 million VND par value with an 8% coupon rate. Because the market rate is exactly 8%, these bonds are issued exactly at par. Step 1. They collect a massive 10 billion VND, debiting cash and crediting 3431. Step 2. Every year, they faithfully pay 800 million in interest, debiting 635. And Step 3. At the end of the 3-year term, they clear the liability from their books by repaying the 10 billion principal.
But here is a really crucial scenario to chew on. What happens if the market interest rate suddenly rises or falls after Haiphong Co. issues these bonds? Well, the bonds will start trading at a discount or a premium out there in the secondary market. But the absolutely crucial takeaway for us as accountants is this. Those secondary market fluctuations do not change the issuer's original journal entries. Haiphong Co. still owes the exact same face value and the exact same scheduled coupon payments, regardless of what the market is doing.
And that, everyone, brings us to the end of Chapter 3. Let me tell you, accurately logging these receivables, payables, and debt instruments is exactly what separates an okay student from a truly great accountant. But I want to leave you with a provocative question to ponder before our next session. If a company perfectly manages its accounting records, perfectly logs every journal entry, but fails entirely to accurately forecast the actual cash flow coming in from these receivables and going out for these payables, are they truly solvent or are they just structurally bankrupt on paper? Think about that tonight. Review these principles, really master these fundamentals, because Chapter 4 is going to build directly on top of everything we did today. Class dismissed. I'll see you all next time.